Welcome. My name is Sasha Moore, and I'm delighted to moderate today's inaugural Trail Book Masterclass live webinar, where we'll have the privilege of getting specialist commentary and insights from industry veteran and Trail Book specialist Nick Young, who is also the managing director and founder of the leading Trail Book company, Trail Homes. Welcome, Nick.
Thank you, Sasha. Great to be here.
Great to see you, as always. We also have with us today SME accounting specialist Justin Mastoris, partner at Rees Group. Welcome, Justin.
Good morning. Welcome, everyone.
Good to have you. And finally, we're joined here by Luke Gardner, who's a broker and the founder of Loans for Homes. Welcome, Luke.
Morning, Sasha. Thanks for having me.
Great to have you as well. So let's start by the reason that we're holding this webinar, which is while Trail is often the largest asset a broker has built, many treat it passively. So our view is that education helps unlock its full value by helping brokers see multiple strategic uses, not just a sell when you retire scenario, which is what we're going to explore today. So on that note, what our goals for today are is to really reframe a trail book as a strategic asset, not just a passive income. Show some situations of when and how you can monetize that asset, whether that be full sale, part sale, using trail as equity and so forth, and depending on the different stages that your brokerage's life cycle is in. We're going to look at how trail can be an alternative to traditional funding and commercial loans and using it to leverage liquidity. And we're going to provide some practical guidance on the valuation, sale, purchase mechanics, due diligence, and legal and tax implications. So we've got a lot to get through, but we want to make today as interactive as possible. So please be sure to feed in any questions you have for the panel via the chat function or the Q&A function, and schedule permitting, we'll address these at the end of the session. So Nick, starting with you, let's get an understanding of a trail book in terms of what it comprises and moving on to which trail books are worth more than others and why. So if you want to pull up the goodwill graph on your screen, if you choose, that would be great as well.
Well, before we get to that, Sasha, I was actually thinking you were going to pull up that graph rather than me, but anyhow.
Well,
But before we get to that, because you put me straight onto one of my soapbox agendas here, trail books to me, when I think about a trail book, I think about purely a group of loans generating trail. Now, in the industry, there's a lot of people who talk about a trail book, and then what they're really talking about is a business. So I'll often get phone calls saying, have you got any trail books for sale? And what they're really actually looking for is to buy a business. And indeed, there's some people who have been very much caught out because they've attempted to buy a business, but all they've actually ended up with is a trail book. So when we buy a trail book, just to be really clear, it's an agreed group of loans. So there might be 10 loans, be more than 10 normally. Let's say there's 100 loans, and it's the trail off those loans. And it's the trail off those loans for as long as those particular loans exist. So at the end of the day, I expect they will all be refinanced, discharged, and we will end up with nothing. Conversely, I expect the selling broker as a starting point to continue to service those loans and indeed refinance those loans. So people think that we're mad here at Trail Homes because, what about churn? But yeah, all of that. Potentially you can sell the book to us today and refinance them all tomorrow, and you will earn upfront some trails off all those new lines. The bet we're making, of course, is that you're more professional than that, and even if you weren't, you're not going to be able to refinance them overnight anyhow. So have you got the chart up there, Sasha?
I love a live webinar scenario. So I'm just going to throw to you, Justin, for one moment, because I know that you
Let me
specialize
get
in the
it. Let
brokerage
me get it.
market. So holistically, I'd love to get your thoughts of how you've seen the use of trail morph over the years, and in particular, just in terms of the different strategies that you've seen brokers now apply to that.
I think we'll run through a few examples later on, but what we often see is where a broker might want to raise some money and actually sell part of their book. And if structured correctly, there's some really fantastic tax options for people that with some small business concessions, which I'll talk about in a moment, where you can structure that really well. And we'll talk about buybacks as well. Sometimes it's raising capital to grow their business. We did a series many years ago on sort of the stages of a broker's business and raising money to hire staff and invest in infrastructure and related. So we've seen a lot of examples. It all ends, a small sale of part of the book to a group of brokers selling their whole business as such, not just the mortgage book of clients.
No, indeed. And let's just keep pressing on, and at the appropriate time, we can refer to this graph because it is really valuable. But Nick, I think what we want to start to look at is I find it really interesting that some trail books are worth more than others, and that there's quite a formula or a structure that you assess in terms of determining this.
There
So.
is. Oh,
So perhaps if we can go into that.
okay. So, Sasha, there's no such thing as a bad trail book. We buy them all. But there are, from my point of view, better loans than others. And if you think about this idea that we're just buying the right to trail off a particular loan, it all comes down to the average life of particular loans. So some loans typically last longer than others. So the worst loans, if you want to think about that, are commercial loans. They tend to get refinanced much more quickly than residential loans. Then we have, in no great particular order, and again, they're not bad loans, it's just that they tend to have a shorter lifespan. First home buyers tend to turn over their properties more quickly than more established homes. So first home buyers, the loans associated with them tend to not last as long as the average. Similarly, we have fixed rate loans, which almost by definition, yes, at the end of the 2, 3, 4, 5 year fixed rate period, they automatically roll into a variable rate loan. But typically we find that at the end of the fixed rate period, there's a review done. And often at the end of that review period, it's decided to refinance the client. So again, they tend to have a lesser life expectancy. Going right to the other end of the bookshelf, the loans that we love the most, it's probably an interest-only loan in a super fund. So that can go on forever. So I get very excited when I'm talking to brokers who say they specialise in SME loans for smaller super funds with lots of interest-only loans in them. So but it's the full spectrum. There's no such thing as a bad one. And indeed, at the end of the day, we just don't know. It's really going to be up to the client as to when they're going to refinance the loan. And that'll be because their circumstances have changed or the loan is not suitable for them anymore.
Okay, great. Thank you. So Nick, staying with you, could you give us just a brief overview of the type of trail book transactions, including different ways a broker can monetize or manage a trail book?
So we broadly have, if you like, three groupings, and it's probably two groupings with a subset or something. But anyhow, the standard deal is we just buy a trail book, and it might be a broker's entire trail book, it might be part of their trail book, but there's no guarantees on it. It's just a straight sale, and typically we're doing those sorts of transactions at 2 times the annualized trail. So what does 2 times annualized trail mean? It's simply last month's trail, simplistically times by 12 gives you the annualized trail, and then times by 2. That said, there is actually an allowance for the number of days in the month. A lot of brokers aren't aware of this, but if you look very closely at your trail book, it will go up and down each month, depending on whether the month it's relating to is 31 or 30 days. And of course, we're in February as we speak now. We talk about the February effect at trail homes, and there is definitely a dip in the number of the amount of trail that will be generated in the month of February. So that's a straight sale, straight 2 times, quick and easy. We then, in more recent times, and it happened about 2 years ago, we launched a new product which we're calling Grow Deals. So it's where the broker is going to guarantee the level of runoff for an agreed period of time. So, jumping in at the sort of the deep end, we might buy your book at 3 times annualized trail, but on the basis that the selling broker is going to guarantee there will be no runoff for the first 2 years, and then it will resume its normal flight path all the way down to zero. So it's been a new innovation, and it's been a particularly interesting one. I think Luke took advantage of one of those grow deals, which we'll come to in a second. So it's been particularly useful for larger brokers wanting to raise more significant capital. The third sort of subset of all of this is what I call the buyback option. So you sell the trail book to us today, and in 2 or 3 years' time, you buy it back. It's done at an agreed multiple, but it's importantly done at the time of buyback. So you sell it today to us, and let's say 3 years' time, I broadly expect your trail book will have halved. So effectively, the price that you pay will be significantly less to buy it back than what you originally sold it to us at the start of the exercise.
Okay, great. Thank you for that, Nick. Justin, I'm going to go to you. From an accountant's perspective, what are the main tax implications for each stage? So maybe we'll start with the straight sale.
So I think what I'll do is firstly start by saying each business, each loan book, each trail book has a unique makeup and client breakup. So it's important to take advice in relation to your situation. There's my disclaimer. But I think across all, and I'll talk specifically with each one, but across all three, I think the main point for everyone listening today is the small business capital gains tax exemption. So essentially, as long as we can construe that we have an active asset that we're selling in this particular case, a lot of brokers can actually take advantage of, and there's some really fantastic tricks in how you structure a deal. That's why the advice is really important. There's essentially 4 exemptions for capital gains tax. So you've worked for many years, you've built up this trail book, you're either under Nick's scenario selling under one of the 3 scenarios that we discussed. There's 4 main CGT exemptions that I'd like to talk about. The first is if you've had the business or book for more than 15 years and you've been working that book for that period of time, there's very much the possibility if you're over the age of 55 that you may be able to avail yourself to the small business 15-year exemption. And what that means is that you could potentially, up to a limit, negate any and disregard any capital gain. So that's really attractive for those that are seeking an exit and have been in the industry for some time and had their business for some time. The second small business CGT exemption is the active asset reduction, where you get to reduce the actual gain by half. And again, the sale with a guaranteed runoff, that'd be really appropriate for that potentially. And depending upon how your business is structured, you might be able to value yourself to a general capital gains tax discount on top of that. So potentially only pay tax on a quarter of the book. So that's a neat little trick. The third one is if one of the brokers is going to be retiring from their business, and there's a retirement exemption, which involves putting the proceeds into superannuation, but you may be at that stage where you're approaching retirement or potentially over 65, and you actually just want to sell and place the funds and invest the funds, take advice of the funds in super. And again, there's the ability potentially to disregard the capital gain by doing that. And what's really interesting then is under the scenario of the guaranteed runoff or sale with a buyback, the 4th capital gains tax CGT exemption is small business rollover relief, where you can defer or elect to defer part of the gain if you know you're going to be buying back part of the book, for example, for a period of up to 2 years. So we often see brokers and small business owners use this to say, well, I've actually made a gain, but I'm either going to buy back in to the book, or I'm going to potentially, buy another business in a similar industry. It doesn't have to be the same industry. And this gets checked by the ATO, but you have a window of 2 years where you can defer your capital gains tax and make a decision around the capital gains. So I think for all three, there's at least 4 main concessions that people can avail themselves of.
Okay, tremendous. Thank you. Nick, did you have anything that you'd like to add to that piece?
No, just how lucky we are to have Justin with us today.
Oh,
Indeed,
exciting
but
stuff.
I guess the key insight is that as all major business decisions, that if you're running by any decision by your accountant, you're always going to be in a greater place of knowledge as well as how to best skin the cat to optimize the tax piece. So let's delve into when in the business life cycle that trail strategies might be deployed to move the perception away of trail just being a static income stream for life to being more a strategic financial asset that can be optimized depending on the business's goals and different stage of their life cycle. So the common thread here is that trail can be used as an alternative commercial debt finance facility. So Nick, can you just briefly talk us through that?
So broadly, there's probably 3 stages of a business. One is obviously its establishment. Then you enter this mature phase, and then we get the retirement age. So broadly, it can be used at all 3 stages. So at the beginning, when you're building your business, capital is critical. So there's 2 ways or a number of ways you can access capital. One's through personal savings, but as we all know, when you're trying to set up a new business, often they get exhausted pretty quickly. Secondly is your home, drawing down equity. And if you're to borrow money, that's probably the cheapest source of funding that you'll find to borrow against your own home. But it involves tying up your own home, and you may have also already exhausted the equity in your home, or you may not have a home. So that is, there's a limited supply. There are some organisations now who will lend against trail books. They vary from typically being quite expensive through to being quite difficult. So the major banks, unless you're looking to borrow more than about $1 million, they will be generally reluctant to lend, and they would often like to have a bit of real estate in there as well. But they're certainly looking for significant transactions, $750,000, $1 million up. There are some smaller organisations all the way down to some groups that will lend very small amounts of money, but as you get smaller and smaller, it can get very, and I can underline, very heavily, very expensive to go down that route. So via us, it's simple, clean. There's no requirement for financials. We don't tie up other assets. It's just your trail book that obviously we're buying, and it's simple and quick to do. So as a funding strategy, great to help build your business. We've touched on the capital gains tax relief, and this is something that you need to talk to your accountant. But once you start moving up into the 50 cents and the dollar tax bracket, there is often, and particularly as you start getting close to retirement and retirement age, not necessarily retiring, but of retirement age, there's significant tax breaks in moving trail books through into superannuation, or the value of them. And then, of course, which we'll touch on later in the session, when we get properly into succession and we're talking about selling a business or part of a business, that's where obviously trail books can come into their own as far as organising a sales strategy.
Okay, amazing. Thank you. So let's move into some actual scenarios, starting with how Trail can support the growth and expansion through unlocking equity. So Nick, over to you, and Luke, you're going to be in the hot seat in this situation, because we'd love to also get an understanding of how you've utilised this facility.
Yeah, I'd love to share.
Perhaps we might start with you, Luke. So tell us a little bit about your business, Luke.
Yeah, sure. Okay. So Loans for Homes, I founded this business in 2012. And like you suggested, Nick, a bit of my personal cash went into it to start the business up. And over the years, I have raised money through several different ways to grow the business and to hire staff. And, sold shares in the business and brought on a business partner over the years. Now I've got a business partner that's 50-50 in the business. Of course, that by bringing on a business partner, you are diluting the shares in the company and giving away some of that ownership, but also responsibility. We've raised money through small business loans as well when funds were cheap during COVID. But yeah, sort of now, what are we, 2025 or 2026 now, but 2025 when I came to you, we just needed another avenue to raise capital and raise equity to really scale up the business. We wanted to go big, and we looked at the other funding options. We didn't really want to dilute the company any further or bring on any further shareholders at this point in time. We're open to it in the future, but we weren't ready for it at that point in time. And your name popped up, and
So
we're introduced.
yeah, so you did a grow deal. We won't go into the exact details of
Sure.
a grow deal, but typically grow deals are, for hundreds of thousands of dollars. They're typically not for millions of dollars, but they're typically for hundreds of thousands of dollars. And we have a minimum size of generally 250,000 is the minimum size we like to do. So you used that well, tell us, what exactly did you use that money for?
Yeah, good question. So we used it for a number of things. So mainly hiring staff. So we wanted to scale the business. I wanted to step off the tools. I'm not completely off the tools yet, but I wanted to step back and sort of grow and manage the business and mentor, take on that sort of a leadership role. Prior to that, I was a full-time broker in the business. So found it very hard to manage and to lead the team whilst on the tools. We've spent a bit more on marketing. We're now on the socials. I'm a bit old school and took me a while to get on there, but doing a lot more on the social media, but also local area marketing and branding, which has really helped us to fill that top of funnel and get more or drive more leads into the business. And we've already noticed a huge shift in top of funnel or leads coming into the business. And I can honestly say that since we've approached you, Nick, and helped sort of raise that capital for us, that the loss of income that or the income that we've lost on the trail, we've now made up for that, plus on the upfronts that we're now receiving on the higher revenue.
There you go. So that was a bit over a year ago, I think we did your deal.
That's
there.
right, yeah.
There we go. So
actually, not quite. Sorry, just under a year. Yeah.
Just under a year.
Before we progress, Justin, I know you've got your hand up. You're eager to contribute.
So I just wanted to say, just in relation to Luke's deal, and I didn't advise Luke in relation to that grow deal, but I come back to this structured correctly. So structured correctly, given that he was reinvesting back into the business, there's the ability to essentially negate capital gains tax if the deal is done right and it's contracted correctly in the structure and the way it's done. So I just wanted to use that as an example of one of the concessions I spoke about, which was the small business rollover. We're essentially rolling the funds back into the business. If done properly and contracted properly, you shouldn't be paying any tax in that situation.
Thank you.
Thank you.
Nick, back to you.
So just to follow up on Justin's point, particularly if in a higher tax bracket, this starts to become a really attractive way of raising capital. All right, let's so back to you, Sasha.
Okay, great. So, Luke, I'm just interested in your story because what I find really fascinating with using Trail as an alternative debt facility, that it can be sliced and diced so many different ways. And so I was just wondering what your thought process was in terms of choosing Trail opposed to other facilities. Not to say that one's right or one's wrong, but I'm just interested in why you came to the decision making that you did.
Yeah, sure. Look, I'd never considered, I think like most brokers in the industry, it hadn't occurred to me. I always thought that, when you're retiring, that's when you sell your trail book, not beforehand. I always thought that if you were selling a trail book, you had to sell the whole trail book, not a portion of it. And also that by selling the trail book that you gave away the clients as well. You're passing them on to somebody else. So we had someone within the industry, within our aggregator group actually, that referred me to Nick. Before being referred to Nick, we had looked at other options. And like I said, previously I had raised capital through other methods, and one of them was bringing on a business partner. And at that point in time, I thought that was the right decision because I had someone in my business that was fantastic, was a gun, and who I wanted to retain. So it was sort of not just to raise capital, but it was a retention sort of method as well. And we do have some other young gun brokers in the business that at some point in the future I would probably offer the same to, as part of a succession plan, giving them the golden handcuffs. But I don't think that they have the capital. When we asked, they didn't have the capital behind them. We weren't asking for a small amount of money. We needed a large sum of money to do the things that we wanted to do. And they just didn't have that sort of capital. And we weren't ready to give away a small percentage of the business for us. It's too much work for that small investment. When we borrowed money before through the banks, that was again during COVID. Funding was cheap. I think we were paying 3.99% on a small business loan. That sort of funding we found wasn't available this time around. It was higher rates and also a lot of paperwork. And then enter Nick and Trail Homes. And I was just surprised at how simple the process was and how flexible. Nick was really, really sort of flexible with the terms. We did go for we bought the grow deals method, the 3 times cover guarantee for 2 years. And not that I can remember, there wasn't much paperwork involved. It was very transparent, no hidden costs. And a really, really simple process compared to the other methods that we used in the past. And before approaching Nick or even reviewing any of the other options, I think it's important that if you are a broker considering this, you really want to understand your business and the opportunity cost of doing this or not doing this. You don't just go and raise capital or release equity for the sake of it. We knew exactly what we wanted to do with that money and how we wanted to spend it. And we'd also done a bit of forecasting and mapped out, if we spent that money in those areas, so marketing, branding, hiring new staff, training and development, where we thought the business would head and how we would recoup that money, because you are giving away part of your trail income, but how we would recoup that in terms of new upfront revenues and how long would it take us to recoup that lost trail as well. So there was a lot of forecasting and planning, and it has gone to plan.
Fantastic. I'm so glad to hear that. I always love hearing a good growth story. And one thing we were also talking about offline was the role of de-risking in your decision-making process. So I found that particularly interesting. Perhaps you can also just share that.
Yeah, again, something else I'd never considered in the past, but I was just having a beer with a mate one day, not in the industry, not a broker, completely different line of work and different industry. But he started off like me as the sole shareholder director of a small business, and that business grew over time. It's now a very, very big business, much bigger than mine. And he raised the concept of de-risking, and I asked him, what do you mean by that? He said, well, you look at it this way, most people, self-employed, they start off as the sole director shareholder of a company. They grow that company, if it's successful, to be quite a large company worth quite a lot of money. And they are still the sole shareholder, sole director, likely sort of key person in the business as well. So everything rests on their shoulders. And if you're in an industry like ours where it's constantly changing, there's AI and tech disruptors, you'd have to be, I think, pretty naive to think that you're safe and that nothing can happen and that the business can't be devalued in the future, or AI is not going to take over. And I'm not one of those people that thinks that it is. I think AI and the human element combined are better than, stronger than AI or tech on its own. But the concept of de-risking is that rather than having all your eggs in one basket, why not release some of that equity or raise some capital against that asset, which is your trail book, and invest that, diversify that, and invest that elsewhere. It can be back into the business in terms of growing the team so that you're no longer key personnel. You've got a team around you. It's not all on your shoulders. But it can also be, I didn't use all the money to invest it back in the business. I did take some out for my personal use to invest back in property and shares and other assets. So that's what I mean by de-risking. And the way that he put it to me was, if you were starting out today and you had $1 million, would you go and invest that $1 million all on a loan book or some other stock or asset? You probably wouldn't, right? You'd probably diversify and invest a little bit here, a little bit there. So yeah, that was just something that resonated with me.
No, I love that. Thank you. So, Justin, before we move on to the succession planning piece, was there anything you'd like to add in terms of the tax benefits for this situation, or have you covered it?
I think just the grow. I just want to reiterate the grow deal. If structured correctly, with one of the exemptions, there should be next to no tax payable, and also if the transaction's under a couple of $1 million with the right advice. And back to Luke's point, if you're prepared to diversify, invest into superannuation with the right structuring of the deal, there should be next to no capital gains tax paid, because there's more than enough concessions available if you're prepared to put money into superannuation under a couple of different veils. Again, the right advice to minimise, we're talking about hundreds of thousands of dollars of difference in tax if you do it right. And as Nick said, if you're on the top tax bracket, even if you're a sole trader, there's still so many opportunities for you to really minimise. I'm happy to talk to people about that in a deep dive in the future.
Can I just jump in there quickly, Justin, and add to that? We had some tax advice, some solid tax advice before we structured this deal, and we are taking advantage of the CGT concessions. But we have been told that we will need to pay a little bit of CGT, not a lot, a little bit. But I think again, it comes down to that opportunity cost. If there is CGT payable, so be it. It's about the opportunity cost. What are you going to do with that money? And how are you going to use that money to help your business grow or help you diversify into other asset classes and de-risk? And again, for us, I can honestly say that even with the CGT payable and the other, the loss of the trail income that we've given away to trail home loans, we have grown the business and scaled the business to another level that I don't think would have been achievable had we not raised that capital.
Fantastic, thank you. Okay, so we've talked to this great growth piece, and now let's move to succession planning and using Trail as an exit strategy. So Nick, over to you in terms of how a broker might optimize this process.
So again, this is one of my great hobby horses here, Sasha, and excuse me because I am going to do a bit of a deviation here.
Of course.
So there's I'm pleased to say it's starting to decline, but for a long while there's been this idea in the marketplace or amongst mortgage brokers that I'm going to retire and I'm going to live off my trail, and that's my retirement strategy. And indeed, I'll have people arguing with me till they're blue in their face that I've got a trail book that generates $10,000, $20,000 a month. And, I can live quite comfortably on that, Nick, all the way through my retirement. And I'm going, well, yes, but it doesn't last. Oh, Nick, you don't understand. My trail book's been generating this $10,000 or $20,000 forever. It's just relentless. Every month it comes in, never moves. And they just can't get it into their heads that if you retire, the loans stop coming in and the trail book falls. And it falls and it broadly halves every 3 years. And it's very, very sad to get a phone call 3 years into retirement and the person's retirement strategy is just a complete disaster. They owe money all over the place. I end up buying the remains of a trail book to try and sort of retire some debt. But if it had been addressed properly at the start, their retirement would have been such a different story. Now, when I say addressed at the start, it doesn't mean that I want to retire next week. And I've also had phone calls of people saying, I've decided that I want to retire and, can we organise it by, next month? This has got to be done years in advance. Now we've got the chart up here that this magical chart. It's not a very complicated chart, but it's actually one of my favourite charts. So it's a very simple mortgage broking business over time. So day one, over on the left-hand side, we've got the orange line, which is meant to represent upfront commissions. So we'd like to think that we start this business up today and we fairly quickly start settling loans and the upfront commissions start kicking in. The green line is the trailing commissions. So the trailing commissions obviously start up much more slowly than the upfronts. But over time, as this graph depicts, the two of them start to meet. And you may or may not be aware of this, but given the average life of a loan and given the average upfront of 0.65 and an average trail of 0.15, it actually falls out of that in a mature mortgage broking business, about half your revenue will end up coming from trails and the other half will come from upfronts. And indeed, one of the little tricks that I employ is I'll ask the broker, and I try and do it very casually, not trying to make a big deal out of it, but, typically, how much business do you write? And they might say, oh, I'll write 2 million, whatever the number is a month. Oh, that's good. And I'm quickly going. So that's about $12,000 a month in upfronts they're earning. And just approximately how much trail would you be getting? Now, if the broker says, oh, I'm getting, I don't know, $9,000 a month trail, Nick, I go, right, this person has got a growing business. Their upfronts are exceeding their trails. Conversely, if they say, oh, I'm writing about 2 million a month and I'm getting about $12,000 a month in trail, I'll go, right, they've got a mature business. On the flip side, on the back end, if they tell me, yes, I'm getting about $12,000 a month in upfronts, but I'm getting about $20,000 a month in trails, this is a business in decline. Now, let's just talk about businesses in decline. So businesses in decline are where the upfronts are less than the trailing commissions. On average, but consistently over time, they're less. So this is a business, and you can probably almost hear the person talking. I don't need to market much these days. I just really rely on repeat business. There's often a conversation about quality of life, and we're buying a van and we're driving around Australia, and I've worked out how I can service my clients out of the back of the camper van. You get very good reception all across Australia these days. It's a lovely scenario. It's not good for the business, and what you're actually seeing happening is the goodwill in the business being squandered. Now, goodwill is really valuable, and goodwill is potentially half the value of your business. So a good trail book I'm buying for about 2 times. A good business these days is trading for up to 4 times. That extra 2 times is the goodwill. The reason you pay up to 4 times is because there is an expectation that the buyer will be able to lock into settling these upfront commissions going forward. So effectively, there'll be a transition, not just of a group of trail off a group of loans, but they'll actually, the clients, the goodwill associated with that mortgage broking business will transition across. Now, I think we're going to do a deep dive into this in a month's time, Sasha. We'll be going in much more detail on this whole how you organise succession and do it properly. But I'll give you a tidbit today. The best succession plans, and by best I mean the ones where the seller gets the most money, it's normally about merging. It's about bringing somebody in, or it's about merging your business in with somebody else. So it's a process that happens very much over years. It's not done over the course of a month. And I strongly urge everybody who's wanting to go down this path to think about that. But even if you're not going to go down the merger path, to put in place a plan as to how I'm going to maximise the goodwill in my business and cut out cleanly rather than squander my goodwill.
Thanks for that, Nick. So yeah, just on that note, we have had a lot of tremendous feedback in the lead up to this webinar. and really a lot of interest in the growth piece, but a lot of direct conversations about the succession planning piece. So hence, we've put into the chat function a link. So if you'd like to register for the succession planning deep dive webinar, is going to be on at 11 o'clock Australian Eastern Daylight Time on March 17. We will share that after the webinar as well, but if you'd like to get a head start and make sure that that's in your calendar, you can access that via the chat function. So Justin, I'm going to throw to you in terms of the tax implications or benefits for that succession planning structure.
So my main comment here, Sash, is that the reality of the succession piece is probably the most simple when it comes to structuring the tax implications because of the ability to be able to contribute into super. And I know we've got some questions coming up about that, but essentially, if you are selling your business or your book, it is relatively it's relatively straightforward to take advice on essentially mitigating the tax and using superannuation to essentially be the vehicle in which you invest. And then, you've got to take advice on your pensions and all those sorts of things in the future from an income stream point of view. But the succession model and the sale of that business is a lot easier to structure than some of the others. It's probably my only comment.
Okay, great. Thank you. So we've had quite a few questions come in, which is tremendous. So we've got time to answer quite a few. So if you have any questions and you haven't put them through, by all means, please do so. Nick, I'm going to throw to you first. We've had a question come in from Dean asking what benefit to the buyer and seller with regard to the Trail Book buyback method. So the respective upside, I guess, to both the buyer and the seller.
So I'm the buyer. So just to remind everybody, I'm not a broker of trail books or a broker of mortgage broking businesses. We're an investment fund. We actually buy the trails. So I'm the buyer. So from my point of view, it's only an option that the seller has the right to buy the trail back. To be blunt, I'd probably prefer that they didn't. I actually, to be blunt, make more money if I get to keep the trail book forever. But that doesn't necessarily suit everybody. So as a starting point then, as we go back to the seller, you'll often get somebody who's got a short-term blip. So one of the first times we did a buyback deal was somebody who was due an inheritance in a year's time. They knew they were due this inheritance. I won't go into the exact details of it, but it was going to get a little bit messy. People can probably draw their own conclusions as to what was going on in this person's life. So they needed money today, but figuratively they knew they were going to be rich in a year's time. So okay, I've got a funding problem here, but it is only a short to medium term situation. So I need to get myself over this hurdle. A loan might have worked, but they ended up going down the selling the trail book today and then buying back the trail book at a future point in time. If things hadn't gone according to plan and the inheritance for whatever reason didn't materialise, obviously they would have been very disappointed, but there was no requirement on them to buy the book back, as opposed to if they'd taken out a loan and then the inheritance didn't materialise, the loan would have still been there and they still would have had to repay it. And that could have been a very nasty situation for them. So it gave them the option, but it didn't give them the obligation to have to buy the book back.
Great, thank you. Justin, we've had a question come in from Chris saying, I'm a sole trader and have owned my business for 7 years. If I switch to a company structure, will the 15-year CGT exemption clock restart?
So that question sounds, thanks, Chris, that sounds fairly simple, but it's not. Essentially, what you need to do is take advice to ensure that you don't just switch to a new structure. You roll the business from you as a sole trader into a structure, and generally a company structure with you as the shareholder. So you remain what's called the test individual. So there's a continuity of essentially ownership from sole trader to you being the owner of the company. In that situation, you would avail yourself to the continuity of ownership, and there's a continuity of ownership test without boring everyone. People know I like to speak, so I'll stop at that. But again, Chris, I think taking the advice and getting someone like myself to structure the rollover for you is really important, even though you say, oh, I'm just a sole trader, but you do need to do that properly, because the ATO, just a point for everyone, the activity in the last couple of years is definitely increasing, and the ATO is checking. So, we're seeing for the first time in 10 or 15 years, we're seeing the ATO checking active asset tests. They're actually doing post pre-lodgement, pre-tax return lodgement reviews, and also to, if they're not getting the right answers, audits. So again, really important to spend a little bit of time and effort and money to get the right advice to do it properly.
Great, thank you. I'll answer just a quick question. Ben has asked whether we're going to be able to get the recording after this session. So the answer to that is yes. We'll be in touch with everyone after this with CPD points and the recording, so you'll have this as an asset to refer to in the future. I also want to say thank you, Michael, for the shout out. Michael said, I used Nick in about 2006 to buy a book of clients and found him to be professional, knowledgeable, and accommodating. So that's nice to hear, Nick.
Thank you, Michael. I've dealt with a few Michaels over the years, but whichever one you are, Michael, thank you.
Michael, we shouldn't say surname.
Oh yeah, I thought I should probably not say the surname, but Michael, we hear you and we appreciate that.
I can attest to that as well.
Look at all the love in the room.
You're going to make me blush now.
I know.
So,
all right. So Nick, staying with you, we've got a question from Sean who's come in. With the merge scenario Nick addressed as a method of maximizing goodwill, is there a preferred partner type to merge with, as in another broker, accountant, etc.? And what factors should be considered here?
And this is where you start getting into the deep dive. So yes, you need to think about it carefully. I don't think there's this is what a perfect merger partner looks like, but there's obviously got to be a business reason for it. So merging, and I always talk about hairdressers, and it's probably, I shouldn't, but anyhow, merging with a hairdresser is not going to do anything for the business. So there's got to be a synergy there. So obviously another mortgage broker, clearly there'll be a synergy there. Another firm that potentially can generate significant referrals for you, accountant, financial planner, all potentially a good idea. They may already be a good referral partner with you, and becoming closer through a merger might actually be a benefit to both parties. So, the old 1 and 1 equaling 3. The other one, of course, is the cultural fit. It's often overlooked, but really, really important. It is like a marriage. This has got to see through the passage of time. Trying to work out whether there's a cultural fit. It's really simple. Do you get along with them? Do you like them? If you like them, then probably your clients are going to like them as well. Whereas if you're not entirely comfortable with them, your clients are probably not going to be feeling entirely comfortable with them. So those are sort of probably the key things that I look at. So is there a good business reason? And Justin, I see he's got some comments here. And a cultural fit are probably the two major driving forces. Justin.
Oh, and so just in our experience with all businesses, mortgage businesses as well, is if you are looking at mergers, understanding and being really upfront about what happens if it doesn't work. So making sure there's a shareholders agreement in place so you understand this is the valuation methodology we're going to use. It hasn't worked out in 2 or 3 or 4 years' time. We did everything possible, but knowing what it looks like, so there's no fights at the end. It's just a mature discussion amongst adults as opposed to lawyers benefiting from the process.
And a great point, Justin. Particularly at the start, I like to, call it a heads of agreement if you like, but it doesn't need lawyers. In fact, it's often better if it's not. It's just the two merger partners chatting to each other, but doing it in bullet point written down so that, it's actually there in writing in a bullet point that I'm planning to be gone in 2 years' time. I'm going to help with the transition, but I will be gone in 2 years' time. It puts time frames around things, whereas if things aren't written down, as I say, just in brief bullet point form, doesn't need to be an essay. One side can get a different idea about what the other side was really intending.
Indeed. And I think to flow on from that, we've had a question come in from Janelle. Nick, once you buy the trail book, who works with my old clients for further finance, etc.? So perhaps that's an important distinction to make in terms of your model versus other models in market.
Yeah. So as a starting point, I expect the selling broker to continue to service their clients. So most of the deals we do, the selling broker has got no intention of leaving the industry. They're just like Luke's done. They're looking to raise some capital for whatever reason. It may be to further their business. It may be to buy a speedboat. It's probably not a good use to buy a speedboat, but that's your call. But more importantly, I expect the selling broker, I expect Luke to continue to service his clients. When we buy a book, we do not get telephone numbers, email addresses. We can't contact these clients even if we wanted to. It's just effectively a commission statement is all we end up seeing. So that's all we get.
And
If the,
sorry, go ahead.
if the person, the selling broker, is leaving the industry, then we expect them to effectively make arrangements with somebody else to service their clients. Now, if they're really stuck, we can go to their aggregator, who I'm sure will put forward another broker to step into the opportunity. But those opportunities, and it's not something we're directly involved in, we would expect the selling broker to enter into some sort of financial arrangement with that broker who's going to service their clients going forward, where they'll get a share of the upfronts and trailing commissions for a period of time, or whatever the arrangement might be. Sorry, Sasha.
No, all good. Thank you. So, Luke, I might throw to you because it would be good just to get your overview of how that worked. Particularly, the Grow deal that you did. Was it just business as usual?
Yeah, that's right. Yeah, so the way I look at it, you're not really selling your book or your database. You're just selling the rights to the trail income for a period of time for a section of your book that's carved out on those agreed terms. But it's business as usual. So all of those clients that we have essentially sort of given away a share in the trail income, they're still our clients. We still speak to them. They're still on our emails, the database. They get all our monthly newsletters. If they come back to us for a new loan, we can write the new loan. If they come back to us and want to refinance the loan that we've just sold the trail income for, we can rewrite that, refinance that loan, get the upfront again, and take the trail back off trail home loans. In saying that, we have guaranteed Nick and trail home loans that will be paying them a certain amount each month for the next 2 years. So, but yeah, business as usual. No one else contacts your clients; they're still yours.
I think just on that, Sasha and Luke, and I see this sometimes. I hear people who are wanting to sell a part of their trail book, but with clients. I have a particular dislike for that. My view is that's a breach of privacy. I sort of have this picture in my mind of somebody with a filing cabinet wheeling it up and down the street saying, who wants to buy my trail? But more importantly, who wants to buy my filing cabinet full of client details? It's a clear breach of privacy. In theory, to do that, you need to get the individual approval of each of your clients that their client details will be passed over to whoever the buyer is. If it's done as a structured sale of a whole business, that's a different game. But just the selling of part of your trail book, but plus clients, just keep in the back of your mind privacy.
Thank you. Justin, I'm going to throw a question to you. We've had a question come through. If one sells a trail book, can the proceeds be put in super if that person is 75 years old?
So again, situated, there's more detail required to answer this in correctly in detail. But generally speaking, if the revenue of the business was under $2 million and that person had less than $6 million in assets, then the whole proceeds would be able to go into super and would potentially be tax-free. So the short answer is yes.
Okay, great. Thank you. Nick, somebody else has just asked a quick recap of the rough rates and terms of the Trail Book sale. Maybe it could be a good opportunity to say that you sort of explain how they fluctuate depending on market cycles and other variables.
Yeah. So the valuation of a trial book, from my point of view, as a buyer, there's only really two variables. One is the price I pay, and the other one is the expected life of a loan, or loans, and they do vary over time. So as a long-term average, they sit around, I expect about 20%, 22% of the trial book to disappear each year. So if I start with 100 loans at the end of the year, I expect there'll only be about 80 left. It does vary though. Now, during COVID, and people will probably remember quite fondly, the cashbacks that were going on and the quantitative easing that was going on. So we had very low interest rates. A lot of people were doing, to begin with in COVID, a lot of people were locking into rates that, some of them had a one in front of them, not even a two, just a one in front of them was if you really picked it well. So a lot of refinance activity going on. That was then followed up a couple of years later when a lot of these fixed rates were then maturing, and the banks again saw that there'd be a lot of refinancing going on. So that's when the cashbacks really hit the straps. So during that period of time, we saw runoff rates getting upwards of 30% per annum. So when you're used to 20 and you go to 30, that was a huge impact. So we took a view to stay in the market and keep our multiples probably a little bit, sort of in our point of view, from our viewpoint, a little bit uneconomic, but we thought it was important to be there. But we nearly closed our doors up because the runoff rates were so high. From my point of view, I'm thankful that we're seeing life returning to normality now. There's still a few very older fixed rate loans coming out of COVID that are still dropping off, but we're now seeing rates coming back down, runoff rates around about 23, 24%. So we're getting close to our historical averages. So that brings us back to, for a straight sale, about 2 times. On a grow deal, up towards 3 times. If you're looking to sell your business as a whole, just through a broker of mortgage broking businesses, I've been, I must say, I'm a little bit surprised at the aggression in the market. There's been some surprisingly big multiples, and what I would call pretty ordinary businesses going at multiples that I think are too high. But it is what it is. There do seem to be a lot of brokers out there with $500,000 to $1 million to spend on a mortgage broking business. And if you've got a book that comes, or not a book, but a business that comes up in that sort of range of pricing, we're seeing quite strong demand. Whereas bigger businesses, the prices that they're trading at, which generally also by definition are much more successful businesses, I can make a little bit more sense of the multiples that they're trading for.
Fantastic. Thank you, Nick. Well, as we mentioned before, please, by all means, register for the upcoming succession planning deep dive. The link is in the chat function, but we will be communicating that after today. But thank you so much to everyone who has sat through this session. We're so thrilled to have such a level of engagement and interest in these topics. Nick, as always, tremendous to pick your brain about all things trail and how to structure it and slice and dice in different ways to benefit the brokerage's life cycle. Justin, fantastic as always to get your insights on how to skin the tax piece, and really the core takeaway for brokers is engage with your accountant in these discussions to make sure that you're really optimizing your position. And Luke, thank you so much for your insights and just taking us through your decision making and so forth in terms of how you've utilized Trail. Thanks again, and we'll look forward to seeing you next time.
Thank you, Sasha. Thank you all.
Thank you, guys.
Thank you.
Cheers.